In this webinar, we cover the rules for excluding capital gain from the sale of a main home. This webinar includes detailed examples. Section 121 exclusion. The Section 121 exclusion is not the first type of exclusion like this that Congress has passed into law. There was a precursor law to Section 121 that was Section 112, which was enacted in 1951. Section 1112 addressed the issue that taxes on the gain from the sale of a home would reduce the capital available for purchasing a replacement home. What this means is that before Section 121 came into law, which was passed into law like in the 90s, so Section 121 has been around a long time, but you will not believe how many times you will have someone come into your office where they think that they have to repurchase a new home in order to exclude the gain from the sale of their existing home. And the reason why that is because the precursor law, this Section 112 that existed before Section 121, used to require that in order for the taxpayer to exclude the gain, they had to purchase another house. You'd think the 90s was long enough ago that people wouldn't remember that. But literally every year I have at least a handful of people ask me about this. Even sometimes in professional groups. There was a bookkeeping group that I belonged to last year, and one of the bookkeepers in the group actually stated this. I don't know if she was a tax professional or maybe she wasn't, she just wasn't keeping up on her CPE, but she stated that. She had said like, oh, you can exclude the gain on the sale of your main home, but you have to buy another one, which is not true. That has not been the law since the 90s. Just so you realize, if you have clients that come into your office and they're asking about how they can exclude the gain, or they come up to you many times and they'll say, oh, well, I don't have to recognize any gain because I bought a new house. That's not how Section 121 works. It has nothing to do with whether or not you buy a new house. It doesn't matter if you buy a new house with the proceeds. That's the old law. You don't have to purchase a replacement home with your gains under Section 121. We're not talking about anything else. If you have the sale of a main home and you sell your house, then you don't have to repurchase another house. You could blow all the money at the casinos if you want to in order to exclude the gain. The rules are different for excluding gain. You have to meet certain tests in order to exclude the gain. But what you do with that money is really irrelevant after the fact. Okay? The old law was Section 112. The current law is Section 121. Okay? Current law allows a taxpayer to exclude the gain from the sale of a main home, not a vacation home, not any other type of home. It has to be your main home, which means it's the home that you've been living in most of the time. Up to $250,000 of gain may be excluded by single filers. It's $250,000 per person, although there are special rules for married couples that are a little bit more beneficial, as well as widowed taxpayers who have lost their spouse due to a death. There's some special rules for them that get beneficial tax treatment. But in general, it's $250,000 of gain can be excluded by each person. Generally, if the taxpayer can exclude all of the gain, it is not necessary to report the sale. And this is the IRS position. This is what it says in the pubs. But I'm going to tell you right now, whenever a person sells their house, even if you can exclude all of the gain, it's a very good idea to report it on the tax return anyway. Usually your software will have something like a sale of home worksheet or an entry screen where you can report the sale of the home. And I suggest doing that even if all the gain can be excluded. Because many times when people move, they won't get a Form 1099-S, which is the form that's generated when you have a sale of real estate. And then the IRS will send them a notice afterwards. The IRS will think that it's a taxable sale because it wasn't reported on the tax return. So I do recommend that even if you have a situation where the taxpayer's gain is all excludable, that you report it on the tax return anyway and save yourself a headache of responding to a notice later or after the fact. It's very, very common to see a generated notice with a home sale because taxpayers got a 1099-S and thought that they didn't have to report it. And even though all the gain is excludable and not taxable, the IRS is looking for that transaction to be reported on the tax return. Now, if you have a home sale that doesn't qualify for this exclusion and you have to report the gain, or if you have a situation where a person has a lot of profits on the sale of the home, which sometimes will happen in states like California, New York, where if they've held onto the home for a really long time and they do qualify for the exclusion, but they've made so much gain that there's still taxable gain, then the sale has to be reported on Form 8949. Gain from the sale of a residence that is not the taxpayer's main home must be reported as taxable income. So for example, if you have somebody who sells something like a vacation home or a second home, then that gain has to be reported because only the sale of a main home is going to qualify for this exclusion. This is the Form 1099-S. This is the form that taxpayers get when they sell real estate. And this doesn't just apply to homes. This can be something like farmland or raw land, business buildings, anything like that. If they have a real estate transaction, the Form 1099-S is what they will receive, where it shows the gross proceeds. It doesn't come on a 1099 miscellaneous, okay, just so you know. It's a 1099-S. This is specifically for real estate transactions. And sometimes when you have someone who sells their main home, they won't get one of these. It won't even be generated because the gain is supposed to be excludable in many cases, you know, if a person meets the tests. But sometimes this will be generated anyway, especially if you have a situation where the sale price is really high. Like if you have someone in California and they sell their home and, you know, it's $1 million home or $700,000 sale, there's a good chance you're going to get this one anyway, the 1099-S. And then absolutely you have to report it on the tax return. Even if all the gain is excludable, you still have to report it and let the IRS know. Reporting the sale of a main home, this is what it looks like on the Form 8949. Your software will generate something like this, where it'll say main home, Section 121 exclusion, like that. And then you put in the date that you acquired the property, the date that it was sold, the proceeds. As you can see, there's the basis would be right here, and the amount of the adjustment. Let's say this is a married couple. This is an example from the IRS publications, by the way. You can see right here, the amount of the adjustment is the exclusion. In this case, this would be like a married couple, and then they're allowed to exclude $500,000 if both of the taxpayers qualify. But in this case, the sale of the home was so high, the proceeds, that they weren't able to exclude all of it, even with the Section 121 exclusion. And then in this case, they have a taxable gain. And the way that it will be taxed is a long-term capital gain. This is typical of a transaction where you might have a home sale where they have a lot of profits on the sale of the house. Only a main home qualifies. As I mentioned, it only pertains to a taxpayer's primary residence and does not apply to rental properties, vacation homes, or secondary residences. A taxpayer's main home is considered to be the place where they reside for the majority of the year. It does not have to be a typical house, but most of the time that's where you see the majority of sales where you have a taxable gain. I mean, it could potentially be something like a houseboat, a mobile home, a condo, any of those things. Those would all qualify under the Section 121 exclusion in order for you to exclude gain. But many times with these other types of properties, something like a mobile home, you won't have a whole lot of gain, or sometimes you'll even have a loss because that's not the same as real property that's like attached to the land. But in order to qualify as a home, it must have sleeping, kitchen, and bathroom facilities. At the very minimum, it has to have these three things: a place to sleep, a place to cook, and a place to go to the bathroom and take a shower. Okay, eligibility requirements. You have to know this for the test. Absolutely. We're going to go over the ownership and use test kind of ad nauseum, and I'm going to give you examples too. In order to be eligible for the Section 121 exclusion, the taxpayer must have sold their main home. They have to meet the ownership and use tests, and they cannot have excluded gain in the 2 years prior to the current sale of the home, although there are exceptions when the primary reason for selling the home residence was a change of employment, health, or unforeseen circumstances, which we're going to cover a little bit later in this webinar. Ownership and use tests. Now you need to know these for the test. You've got to memorize what these are. In order to exclude the gain, under Section 121, for the sale of your main home, you have to have owned the home for at least 2 years. That's the ownership test. You have to have owned the home for at least 2 years and lived in the home as your main home for at least 2 years. That's the use test. So you have to own it and you also have to live in it. A taxpayer will meet both of these tests if the taxpayer owned and lived in the property as their main home for either 24 full months or 730 days. That's 365 times 2 during the 5-year period. So you have to look back 5 years in the past. And I know that this is very confusing sometimes for people, but that's the look back period. There's a 5-year look back period. And the reason why there's a 5-year look back period is because the required 2 years of ownership and use do not have to be continuous, which means you could technically own it at one time and use it at a different time, and you could still qualify for the exclusion. So you don't technically have to live in it at the same time that you own it, and vice versa, which I know is weird and complicated, but that's how it is. There's a 5-year look back period where you look back in the past 5 years, and if the person lived in the property for at least 730 days and owned the property for at least 730 days or 24 full months in the last 5 years, then they will qualify for the exclusion. I know that sometimes it's hard to wrap your head around these types of convoluted rules. Like, when would this apply when the IRS is saying the 2 years of ownership and use do not have to be continuous? The ownership and use tests can be met during different 2-year periods. And most of the time when people sell their homes, they're living in their homes and they're owning their homes at the same time, right? So you own your home and you're also living in it. Most of the time, that's what you're going to see, where the people will actually qualify for this exclusion. But I have seen taxpayers who have qualified for the Section 121 exclusion, even if they haven't lived in the home for the last 2 years, because they qualified under the 5-year look back period. Most of the time when you see that sort of thing, it's two scenarios. It's one of two scenarios. It's where you have a situation where someone is elderly or they've had a debilitating injury and they go into like a home and the family doesn't want to sell the house because they don't know if that person's going to return to the home. They don't know if they're going to get better or worse or whatever. And they're kind of like in a nebulous holding pattern. The person might be in a hospital situation and they don't know if the person's going to recover. And sometimes the person themselves who is elderly or maybe has gotten sick, they don't want to sell their house. They want to have a safe place that they can come back to. So they're leery to sell their house, even though they might not be able to live in it anymore because of health reasons or whatever, for whatever reason. Sometimes the house will remain vacant for an extended period, sometimes even more than 2 years. And then, the family will break down or the person will say, okay, so it looks like I'm not going to be returning to my house. I have to stay with my daughter, because I have diminished cognitive function or because of my disability or whatever. Things happen, right? And then eventually they sell the house and they haven't lived in it for the last 2 years because they've been sick or they've been in a home or they moved in with family, whatever. But they will still qualify for the exclusion because there's a 5-year look back period. So you can say, okay, well, you haven't lived in it in the last 2 years. It's just been vacant, but you did live in it 2 out of the last 5. And then they'll qualify for the Section 121 exclusion and be able to exclude the gain. The other situation where you see this happening is when people like move in with a boyfriend or a girlfriend. They move in with someone, they meet, and they're like, ooh, I'm in love. And then they move in with that person, but they're not really sure if it's going to last. So they don't want to sell their house. They want to keep their house. They want to keep their house. So they have a place to go back to just in case the relationship tanks, right? Sometimes people, they're a little bit leery to jump in with both feet. They'll jump in with 1 foot and they'll go in and move in with their new significant other, but they won't jump in all the way. They want to keep their house just in case, just in case. Sometimes eventually that couple will get married, or they'll say, okay, well, you can sell your house now after it's been a couple of years. And then they'll sell the house after they've been together with this person for a while, because now they feel safe. And they'll still qualify for the exclusion, because even though they moved out of the home and they went to go live with their new significant other, boyfriend or girlfriend or whatever, then they can exclude the gain, because there's a 5-year look back period. So you can look back 5 years, even though they haven't been living in the home for the last couple of years. And this is true even if you convert it to a rental. You got to really watch it there, because there's some special rules when it's a rental. And then you can have recapture, because you have to depreciate the rental. But you could still potentially qualify even then. It's just that there's a 5-year look back period, and technically the person doesn't necessarily have to be using the home in the last 2 years. Sometimes they will move out, because of illness, or even because they moved in with a boyfriend or a girlfriend, and they can still qualify for the exclusion, because you look back 5 years into the past to see if they qualify for the ownership and use tests. Different rules for married homeowners. Now, the rules for married homeowners are more beneficial than the rules for unmarried or single filers. Sometimes you'll have an unmarried couple and they'll buy a house together, and they can each individually qualify for the Section 121 exclusion. If it's an unmarried couple, they can still qualify for it, but they have to each qualify on their own. In the case of a married couple, they can exclude the gain of up to $500,000, which is $250,000 for each spouse, if they meet all of the following conditions. If they file a joint return, and then either spouse meets the ownership test, which means only one spouse is required to actually own the house. And I've had multiple scenarios of this in the past, where maybe just the husband owns the house or the wife owns the house. Only one of them is on the deed, because they bought the house before they met their spouse. And then they got married, and the husband or the wife, whoever they married, moved in with them, but only one person is on the deed. In the case of a married couple, if they file a joint return, then only one spouse is required to own the house, and they can still exclude $500,000. So that's beneficial tax treatment, because if it's an unmarried couple and only one of them owns the house, then only the one that actually owns the house is allowed to exclude gain. The other one can't. Both spouses must meet the use test. So both of them have to have used the home in 2 out of the last 5 years. And neither spouse has excluded gain in the 2 years before the current sale of the home. If the requirements are not met, the couple will not be able to claim the full $500,000 exclusion for married couples. However, if only one spouse qualifies, that spouse may still be eligible for a separate exclusion of up to $250,000. And I really want you to watch for this on the test. Be careful with this sort of tricky situation. They have to file a joint return in order to exclude $500,000 of gain if only one of them owns the house. If they decide to file separate returns for whatever reason, and only one of them owns the house, then only the one that owns the house is able to exclude gain. In order to exclude $500,000 of gain, they have to file a joint return if only one of them owns the house. Unrelated individuals. Sometimes you'll have a situation where you have people who are not a married couple and they own a house together. They don't even have to be like a romantic couple. Sometimes you'll have other family members that will own a house together, like siblings. They'll say, okay, here's my brother. We're both unmarried, or we're widowed, and we're going to buy a house and we're going to own it together and live in it together. If you have an unmarried couple or other taxpayers who own a home together, they can each take the $250,000 exclusion individually on their separate returns if they meet the use and ownership tests. In that case, both of them would just have to meet the tests individually and report the gain on their individual tax returns. And sometimes you have to just do the math when it's this sort of thing. You have to do it on a spreadsheet or accounting paper and do the math by hand, because you're not reporting all of the gain on one tax return. You're going to be reporting the gain and divvying it up on 2 separate tax returns. Example, Selma and Carolyn are sisters. They are both widowed and decided to purchase a home and live in it together. That's perfectly fine. They're obviously not going to be filing a joint tax return because these are siblings. They're not a married couple. If they later sell the home, the ownership and use tests would apply to them individually. So if both of them are on the deed and both of them use the home as their main home for at least 2 out of the last 5 years, then they will individually qualify for the Section 121 exclusion. Each of them would be able to claim an exclusion of up to $250,000 on their individual tax returns. And sometimes you have to monkey with it a little bit, especially if all the gain gets reported to just one Social Security number. You have to increase the basis on one tax return and then report it on the other tax return. Sometimes you even have to add a disclosure statement, but this is all legal. There's nothing shady about it. If you have a situation where both of them actually legally own the home and use the home as their main home at least 2 out of the last 5 years, it doesn't have to be a married couple, then each of them can claim a $250,000 exclusion, up to $250,000 on each of their tax returns. And you just split it. You just split the gain. If each of them owns the house 50-50, then you split the gain 50-50. It's not that difficult, but sometimes you have to do it manually and then make it work in your software. It's not, your software can't do everything. Can't figure out every single scenario. Sometimes you have to do a little bit of math. Home transferred in a divorce. A special rule for the holding period applies to a home that is transferred by a spouse in a divorce. The receiving spouse is considered to have owned the home during any period of time that the transferor owned it. However, the receiving spouse must still satisfy the 2 out of 5 year use test on their own tax return to qualify for the entire exclusion. This is a tax-free transfer of property incident to a divorce. This is also called a Section 1041 transfer. If it's a transfer of property that's incident to a divorce, either directly before or after a divorce as part of a divorce settlement. And I'm going to give you an example of this in a little bit. So if you do have a situation where there's a property transfer, like the main home is transferred to another spouse, then the ownership period also transfers to the spouse that's receiving the house, even if they didn't own the home before. Deceased spouses. Now, special rules apply to a deceased spouse. This is not the same as divorce. This is not a situation where you break up and divorce. This is a situation where one spouse has died, and there's beneficial tax treatment in this case as well. In the case of a deceased spouse, the surviving spouse is treated as if they owned and lived in the home during any period that the deceased spouse did. This means that the surviving spouse may exclude up to $500,000 of gain from the sale of the home, even if it occurs within 2 years after the death of the deceased spouse. And this is as long as the surviving spouse did not remarry before the sale. And this rule applies even if they're not filing a joint return. You know, in the year of death, you can file a joint return with your deceased spouse, but you can still exclude $500,000 of gain, even if you sell the house within 2 years after the death of the decedent. And that's true regardless of your filing status, even if you are filing single. It's a 2-year period after the death of one spouse that they get to do this, where they can still exclude up to $500,000 of gain. And this is true as long as the surviving spouse did not remarry before the sale. Essentially, the holding period for the deceased spouse is transferred to the survivor, allowing them to benefit from the full exclusion for married couples. And they also get a step up in basis. Generally, when you have a person where the spouse has died, they're going to probably be able to exclude all of the gain, depending on the scenario. I mean, sometimes you'll have a situation where the survivor won't sell the house for years and years afterwards. And then in that case, sometimes they'll have gain that is taxed, because in order for them to get the $500,000 exclusion, they have to sell within 2 years after the death of the decedent. They've got 2 years to exclude $500,000 of gain. And I had another user in the forums ask me specifically about this. How do you do it? You know, how do you report this in your software if it's not a married couple, right? Because you're excluding $500,000 of gain. How are you supposed to do that if it's not a married couple, if you're doing it within 2 years after the death of the decedent? And my answer is that, you know, there's a good chance that your software isn't going to be able to do this right, that you're going to have to do this manually and make a note in your work papers and adjust the bases so that you can make this work. But this is in the code, absolutely. If you have a widow or a widower, someone whose spouse has died, and they do not remarry, then they have 2 years to sell the house and get a $500,000 exclusion. And the surviving spouse, the survivor, is treated as if they owned and lived in the home during any period that the deceased spouse did. So you might have a situation where the spouses get married and they're living together in the house, and maybe the new spouse only has lived in the house with their husband or wife for 6 months, and then their spouse dies and it's sudden. They're still treated as if they owned and lived in the home during any period that the deceased spouse did. So they would still be able to exclude $500,000 of gain. And you think, wow, I've had students say, wow, that seems like really beneficial. Yeah, it's really beneficial tax treatment. It's great. But, somebody has to die in order for this to happen. So it's not that great. It's not that great. Somebody has to die in order to get all this special tax treatment in that case. Very special rules apply to deceased spouses where they can exclude the gain as if it's 2 people on the tax return. Even if they do it in the year after the spouse's death, they still get to exclude $500,000 of gain. There's a special rule for military personnel where they don't have a 5-year look-back period. They have a 10-year look-back period. This offers military personnel a greater chance to fulfill the 2-year residency requirement, because many times they'll purchase a home and then they'll get transferred overseas, and they won't want to sell that home because, it's a valuable asset. It might be going up in value, so they want to keep it. They're allowed to have a 10-year look-back period in order to qualify the ownership and use tests. They're allowed to fulfill that 2-year residency requirement even if they did not live in the home or their spouse did not physically reside in the home for the standard 5-year time frame that applies to everybody else. So they have a 10-year look-back period in order to meet these tests. There's a disability exception as well during the 5-year period before the sale of the home if a taxpayer becomes physically or mentally disabled. They must have owned and lived in the home for at least 1 year. In this case, the taxpayer is considered to have lived in the home during any time that they are forced to live in a licensed facility, including a nursing home. The taxpayer must still meet the 2-year ownership test. So in order to qualify for the disability exception, the one that I'm talking about here, this is a person who is still qualifying for a $250,000 exclusion. That's a full exclusion, not a reduced exclusion, which I'm going to cover in a minute. There's disability exceptions and health exceptions that apply to reduced exclusions as well, where maybe you didn't own the home and live in the home for the full 2 years, but you're still allowed to exclude some of your gain. But in this case, we're talking about a person who is still allowed to exclude the full $250,000. In this case, it's a person who did own the home for at least 2 years. They've owned it for at least 2, and they lived in it for at least 1. But at some point, they have to move out and live in a hospital or in a nursing home or some kind of licensed facility because of health reasons. And then they don't meet the use test. They have not used the home for the full 2 years, but they've owned it for at least 2 years. In that case, if they're forced to sell or if they want to sell after they've owned it at least 2 years, then they would still qualify for the full $250,000 exclusion, even though they didn't meet the full 2-year use test, if they had to move out because of a disability. Reduced exclusion. This is a scenario where a taxpayer is allowed to take a partial exclusion or a reduced exclusion, and they're not allowed to take the full $250,000 or $500,000, but they still qualify to exclude some of their gain. And it's based on specific conditions, health-related conditions, job-related conditions, or unforeseen circumstances. And I'm going to talk about that in a minute. I don't know if you're going to have to do the math in one of these scenarios in order to calculate the amount of reduced exclusion or the amount of gain that's actually taxable when you do have a person who qualifies for this, but I am going to give you an example that shows you how to do the math. Reduced exclusions. Now, this is a situation where a taxpayer does not meet the ownership and use tests. They have not lived in the home or owned the home at least 2 out of the last 5 years, or they have already used the home sale exclusion within the prior 2-year period. Like they've already excluded the gain on another home, and now they're selling, within 2 years again, they can still be eligible for reduced exclusion if they meet one of 3 exceptions. If it's a work-related move, if it's a health-related move, or if it qualifies under unforeseeable events or unforeseen circumstances. For a work-related move, this can be something as simple as a job change. You get transferred, or you get a new job even. You get a new job offer and you have to move. The job change safe harbor applies if the new job is at least 50 miles farther from the old home than the former place of employment. The health safe harbor applies if a doctor recommends a change of residence for reasons of health of the taxpayer, a spouse, a child, or certain other related persons. The related person does not have to be a dependent for the reduced exclusion to apply. There's a list in the IRS publications that goes over the different family members that would qualify, but it can also be somebody like a sibling or a parent, mother-in-law, father-in-law, that sort of thing. Those would all qualify under a health-related move if it was a situation where you have to sell your home in order to, for example, go care for that person. They don't have to be a dependent on your tax return. For example, let's say my father falls down and he breaks his hip or he has a heart attack and he needs somebody to care for him. He's not a dependent on my tax return. He's my dad. He doesn't own my house. He has nothing to do really with the sale of my house. But if I have to go take care of him, or if a doctor recommends that he have a caregiver, then if I sell my home, and that's the primary reason why I'm doing it, is to go help him, move in with him for a while and take care of him, then I can qualify for reduced exclusion, even if I haven't owned the home or used the home in the last 2 out of 5 years. I can still qualify for reduced exclusion if the reason for the sale has to do with a health-related move of, myself, my spouse, my kids, or any other family member that might qualify, like a close family member. Unforeseeable events or unforeseen circumstances. In prior years, the IRS used to call this unforeseen circumstances, but unforeseeable events is currently what's in the IRS publications, but either or is fine. This would apply to the owner or to the co-owner, any other co-owner of the home. If the house has to be sold because of unforeseeable events, such as destruction or condemnation, or if the taxpayer or a co-owner of the home died or became divorced or legally separated, or gave birth to 2 or more children from the same pregnancy, that's a multiple births exception, if you want to know what it's actually called. It's called a multiple births exception. If you have twins or more, so like triplets, quadruplets, whatever else, and that's from the same pregnancy, and you have to sell your house in order to get a bigger house, or because you're desperate for money, because now you've got like 1 million kids on the way, then that also qualifies for reduced exclusion. If the taxpayer or the co-owner of the house, you don't have to be married in that case. If it's a situation where maybe it's a boyfriend and girlfriend, and then you're fine, but your significant other loses their job or dies or becomes unemployed, then you would also qualify for reduced exclusion if the unforeseen event actually happens to the co-owner of the home. Doesn't necessarily have to be your spouse. If you become unable because of a change in employment status to pay the mortgage, for example, you become unemployed or you lose your job, then that would also qualify as an unforeseeable event. And then any other event that is determined to be an unforeseeable circumstance in IRS published guidance. There's a lot of PLRs out there, which are private letter rulings, that give advice on reduced exclusions to taxpayers who have requested it in the past for their particular unforeseen circumstance. I've read dozens in the past. So just because it's not on this list doesn't mean it won't qualify as an unforeseeable event. There's a lot of examples out there. But for the exam, these are the ones you're going to have to know because this is what's in the IRS publications. So if it's a work-related move, a health-related move, or one of these unforeseeable events, death, condemnation, job change, loss of job, unemployment, or multiple births from the same pregnancy, then those are all unforeseeable circumstances where the taxpayer will qualify for reduced exclusion and they can exclude part of the gain even though they may have not owned or lived in the home the required 2 years. Land sales. Now, if you sell land, but not the house itself, the gain is not excludable. If you just sell land and there's no house on it, you cannot exclude the gain. In some cases, though, a taxpayer may be able to exclude the gain from selling a vacant lot that is connected to their primary residence. This exclusion can only be applied if the vacant land was used in connection with the main home and the sale occurs within 2 years before or after selling the home. What the IRS does is they treat this as a connected sale. They treat it as one transaction for the purpose of applying this exclusion. It's a situation where sometimes you'll have somebody who owns a lot of property. They'll have a house and it's sitting on like 15 acres, and they might sell part of the land off to a different buyer than they sell the part of the land that has a house on it. Sometimes that'll happen. If you have a closely connected sale, and the exclusion can be applied if it's a situation where you sell the land and the house within a 2-year period. And this exception is in the pubs. I don't think you're going to need to know this for the test. Just realize that this exists. But if the IRS asks you about a land sale where there is no house involved in the mix anywhere, then that is not going to qualify for the Section 121 exclusion. There has to be a house on it. Okay? There has to be a house on it in order for it to qualify for the Section 121 exclusion. If it's just raw land, or even if it's land where a person has built a house and they haven't lived in it, maybe they completed construction and they get an offer for the house right away, and it's just, they can't resist. It's so much money, and woo, they want the money. If they built a house, but they've never actually lived in the house, then they're not going to qualify for the Section 121 exclusion, because they have to own the home and use it as their main home at least 2 out of the last 5 years. In this next section, I will go over multiple detailed examples on how to calculate the exclusion. The first example is a non-qualifying sale. Paula is retired and lives in Miami, Florida. On January 1st, Paula purchased a new home in Tampa, Florida. So she's moving from Miami to Tampa. On January 15th, 2 weeks later, Paula sells her old residence in Miami at a $40,000 gain. She had owned and lived in the Miami home for 4 years. She can exclude all of the gain on the sale of the Miami home. Okay, so the Miami sale qualifies for the exclusion. Paula moves into the Tampa home, but she hates her new neighborhood and decides to sell the home just a few months later. So she hates where she ended up living. On October 1st, in the same year, Paula sells the Tampa home. She has a $6,000 profit on the sale. The sale was not due to a change in place of employment or health. Paula just sold the home because she hated the neighborhood. Because Paula had excluded the gain on the sale of another home within the 2-year period, she cannot exclude the gain on the sale of the Tampa residence. The entire gain is taxable as a short-term capital gain. So that $6,000 profit that she made on the Tampa home, she moved just because she hated the neighborhood, and she had already excluded gain on the Miami residence that she had sold. So she sold really quickly afterwards, and she had a small amount of profit on the sale, but she has to pay tax on the entire profit. And since she owned the Tampa home less than a year, then it's going to be taxed as a short-term capital gain. So it's going to be subject to ordinary income tax rates and not beneficial long-term capital gains rates. Example of partial use. Generally, when you see partial use, this is a situation where it's like a duplex and the owner is living in one side and renting out the other side. They can only apply the Section 121 exclusion to the portion of the residence that's actually their home, their main home. They can't exclude the gain from the entire property sale if they do sell the entire property. And most of the time when you see scenarios like that, it's usually something like a duplex where the owner's living in one side and then they're renting out the other side, or maybe letting a family member live in the other side rent-free, but the other family member doesn't actually own the property, so they can't exclude all of the gain. Example, Karen lives in one half of a duplex that she owns and lets her brother live in the other unit of the duplex rent-free. Now, her brother doesn't own the other half, or he's not an owner on the deed. Only Karen is the owner. So she's living in one half and she's letting her brother live in the other half, but he's not an owner on the property. She purchased the duplex 10 years ago for $200,000. This year, Karen sells the duplex for $340,000 and has a gain of $140,000. Since only half of the duplex counts as her main home, Karen may exclude only half of the gain. She must report the other $70,000 as a long-term capital gain on Schedule D. They could have avoided this if her brother had owned half of the property, like if they had bought the property together. But in this case, only she is an owner. And since she's only living in half of it, then she's only able to exclude half of her gains. Land sale only. Jenny purchased an empty lot 3 years ago for $90,000, planning to build her dream home. Construction was delayed and her house was never completed. In December, Jenny sells the land for $150,000. She had owned the property for more than a year, so she has $60,000 of long-term capital gain. See, because it says she bought the empty lot 3 years ago with intentions of building her dream home, but they were just intentions. She never got around to building her dream house. So she has $60,000 of long-term capital gain. None of the gain can be excluded from income because there is no residence on the property. Section 121 only applies to actual homes and not to an empty lot. Married couples with the ownership and use test. Carlos owns a home that he has lived in continuously for a decade. On June 1st, 2018, he marries Jasmine and she moves into his home. They both live in the house together until December 1st, 2023, when the house is sold. He owns the home, not her, and he married her and she moved in with him. So they've been living in the house together, but he's the only owner. They live in it together until December 1st, 2023, when the house is sold. Carlos meets the ownership test and the use test. Jasmine does not own the home because Carlos is listed as the sole owner of the property and the only one listed on the deed. However, she meets the use test because she lived in the home for at least 2 years. Therefore, on a jointly filed return, they can claim a maximum $500,000 exclusion. Only Carlos has to own it, as long as Jasmine actually lived in the home with him at least 2 years. And that's because they're married. Now, if they were an unmarried couple, if they were just boyfriend and girlfriend and they weren't actually married, then he would not be able to exclude $500,000 because he would be the only owner of the property. It's just his house. And this special rule where you can exclude $500,000 of gain and only one of them has to own the house only applies to married couples. If it's an unmarried couple, they can also certainly exclude $250,000 each, but they both have to meet the test individually. If it's an unmarried couple, they both have to own it and they both have to use it, at least 2 out of the last 5 years. In this case, if it's a married couple, only one of them has to own it. Example number 2, married couples. Irene owns her home and has lived in it continuously for the last 7 years. She meets Julian and marries him in September of 2023. They move in together, but Julian doesn't like Irene's house, and he convinces her to sell it a few months later. Irene sells the home on January 25th, 2024, and has $350,000 of gain. They've only been together for a little while, and she married Julian, and he moved in, but he doesn't like the house, and he's not going to meet the use test. She will, because she has owned the home and lived in it for 7 years. So she will meet the ownership and use tests, but Julian does not meet the use test because he has only lived in the house for a few months. Irene can exclude up to $250,000 of the gain on her tax return, and this is whether she files married filing joint or married filing separately. The $500,000 exclusion for joint returns does not apply because Julian just lived in the house for a few months. He should have not made this decision. This is a bad choice. This is a bad decision on their part. But many times taxpayers will make these kinds of choices when they get newly married without consulting a financial advisor or a tax advisor. And if he just would have waited 2 years, then they could have excluded all of that gain together, even if he was not on the deed. Military exception. Now, for military personnel, they have a 10-year look-back period rather than a 5-year look-back period. So they're given more time to meet the ownership and use tests. Example, Ensign Smith is a U.S. naval officer. He is single and owns his own home. Ensign Smith bought and moved into his home on January 2nd, 2015. He lived in it as his main home for 2.5 years. So he meets the ownership and use test right after he actually purchased the home. For the following 6 years, he didn't live in the home because he was on qualified official extended duty with the U.S. Navy. He did not return to the home during that time and lived overseas. So for 6 years, he lived overseas while he was in the U.S. Navy. He didn't live in the house. Ensign Smith sold his home for a $125,000 gain on December 26, 2023. To meet the use test, he may suspend the normal 5-year test period for the time he was on qualifying official extended duty. This means that Ensign Smith can disregard the 6 years that he lived abroad when he is calculating the period of ownership and use. Ensign Smith may exclude all of the gain from the sale on his individual tax return. Military personnel have a much longer look-back period that they can use. And many times when you have situations like this, they won't even necessarily rent the home. Maybe they'll have a family member or a friend living there, or, a significant other like a boyfriend or a girlfriend. It doesn't really matter who lives in the home if they have somebody like watching the house, or even if it's vacant. That doesn't matter either. In that case, they still get to suspend the period of ownership and use, and they have a 10-year look-back period. As long as they can meet that ownership and use period anytime in those 10 years, and it doesn't have to be continuous. Like, he lived in it as his main home for 2.5 years right after he bought it. But it's also fine if he comes back for a year and then leaves again, and then comes back for another year and leaves again, where there's extended periods of time where he's not living in the home. That's fine too, because there's a 10-year look-back period. So in this case, even though he had 6 years that he lived abroad, he's allowed to exclude all of the gain from the sale. Let me give you an example with a divorce. Example, Theodore buys a home for $400,000. A year later, Theodore meets Kay, and they get married on May 1st, 2020. Kay moves in with Theodore, but the home's ownership remains in Theodore's name only. He's the only owner of the house, and he continues to be the only owner of the house. They start having marital difficulties a few years later, and Kay moves out on February 1st, 2023. 6 months later, they get divorced. As part of their divorce settlement, Theodore transfers complete ownership of the house to Kay. Theodore's basis also transfers to Kay. The home reminds Kay of unhappy times. So on December 25th, 2023, she sells the home for $475,000, making a $75,000 profit on the sale. Kay keeps the entire proceeds from the sale for herself. She is entitled to the Section 121 exclusion because IRS regulations treat Kay as having owned the home during the time that Theodore owned it. So during their marriage, he was the only one that owned it, and he had to transfer it to her during the divorce. I mean, it sounds like he got hosed during the divorce, but sometimes that'll happen. In that case, his ownership period transfers to her. So she will qualify as having owned the home because any of the time that he owned the home will also be considered to be time that she owned the home, because the transfer was due to a divorce. She meets both tests because of this, the ownership and use tests, so she may exclude the entire $75,000 gain on her individual tax return. Example, exclusion after the death of one spouse. Harmony owned and lived in her home for 7 years. She married Gerard on January 10th, and he moved into the home with her. Harmony died suddenly 6 months later, and Gerard inherits the property. He did not remarry. Gerard decides to sell the home on December 1st. Even though he did not own or live in the house for 2 years, he meets the requirements for Section 121 because his period of ownership and use includes the period that Harmony owned and used the property before her death. She owned and lived in the home for 7 years, and because she died, this is not a divorce, she died, he is treated as if he owned and lived in the home for the entire period that she owned and lived in the home. He is also able to exclude up to $500,000 of gain under the special rule that applies to deceased spouses. So he would be able to exclude up to $500,000 of the gain if he did have gain from the sale. And this is true even if he were to sell the home within 2 years after her death. So he could exclude the gain in the year that she died. You know, he sold the house in the same year that she died. So they met and married in January, and then she died 6 months later, and then he decides to sell the home in December. This all happened in the span of a year. But even if he were to wait and sell the home within 2 years, he would still be able to exclude $500,000 of gain if he did it within 2 years of her death, as long as he did not remarry. Let me give you 2 examples of a reduced exclusion. First example, on January 5th, John, who is single, purchases his home and uses it as his principal residence. On July 5th, which is exactly 6 months later, John is forced to sell his home because his employer transfers his job to another state. So this is a job-related move, so it's going to qualify for reduced exclusion. He may exclude up to a maximum of $62,500. And the way that you figure this out is you take the maximum exclusion, which is $250,000. This is the most that he would ever be able to exclude. If he actually owned and lived in the home 2 years, the most that he would be able to exclude would be $250,000. So you take the maximum exclusion for his filing status, which is single, and you multiply that by 6/24. The 6 is the 6 months that he actually did live in it and own it. And then the 24 months is 2 years. So in order to get the maximum exclusion, most of the time, you have to live in the home and you have to own it for at least 2 years. So that's how you get that number. If his gain on the sale is less than $62,500, then he will not have a taxable gain. That's how you calculate the reduced exclusion. Example number 2. Anna, who is unmarried, lived in her principal residence in San Francisco for 1 full year, which is 365 days, before selling it. The sale generated a $260,000 gain. She actually has more gain than the maximum exclusion because it's San Francisco. So I picked a city that's kind of high real estate values. So in San Francisco, $260,000 gain in a year would be believable. Let's just put it that way. Even though she only lived in the house for a year, she qualifies for the reduced exclusion because she recently became unemployed. So once again, it's a job-related move. She has to sell it because she's unemployed now. She's not moving because of a job transfer, but she can't afford her home, and she had to move back in with her parents, it says. Anna can exclude $125,000 of the gain. This is $250,000, which is the maximum that she would be able to exclude for her filing status. And you multiply that by 365 days divided by 730. 365 days is the number of days that she actually did live in it, which is a full year, and 730 is 2 years. The remainder of the gain would be taxable and cannot be excluded. Subscribe to PassKey Online for more great content about the Enrolled Agent exam.